Welcome to episode 6 of the Skadi podcast. In this week's episode, we talk to Dominic Broom, a trade finance veteran with over 25 years' experience. Dominic is a member of the International Chamber of Commerce Executive Committee and sits on the board of the UK's Institute of Export. He has also written a number of white papers on the future of transactional banking. Dominic discusses the history of trade finance, looks at the impact of the current COVID crisis on the sector, and talks about the attractiveness of trade finance as an asset class. If you like this podcast, don't forget to subscribe and share with your friends.
It's episode 6 of the Skadi podcast, and this evening we're talking to Dominic Broom, who is a very experienced trade finance professional. And this is really following on from one of our earlier episodes where we talked to Robert Brooker with his background in anti-procurement fraud. And Dominic, of course, you've been very, very much working on the trade finance side of things, and that has some crossover with procurement. Just explain to us anyway, just to give the backdrop, why is trade finance such an important part of London's financial history?
Well, thanks, Nick, and delighted to be with you all this evening. Trade has been going on for millennia, and certainly for the last couple of millennia in London, ever since Roman times. It's been a historical centre for trade. As people might not think these days, but that was originally built around the fact that London's a port city, and from the Middle Ages onwards, it was a trading hub servicing not only the rest of England and then the United Kingdom, of course, but increasingly the world through the Pool of London and the port that grew up downstream of the City of London along the River Thames. And indeed, as many of your listeners will probably be aware, even today, the City of London, the Corporation of London that runs the square mile and controls so much of the economic and commercial activity taking place in the City of London, is run by the trading guilds, or the descendant companies of those trading guilds, about 110 of them at the current count. And my potted history would say that effectively what happened, that merchants who were trading in goods, and clearly we'll come back to that trade, all-important trade of goods a little later on, they diversified into banking, insurance, etc., with coffee houses within the square mile of London becoming the places of exchange. And what London has always been good at, and remains, in my opinion, extremely good at, is innovation. And in earlier times, that was borrowing innovative ideas from overseas in terms of how trade could be financed and undertaken. Hence, names like Lombard Street in the City of London, where the bankers from the north of Italy back in the 14th, 15th, 16th centuries came and congregated initially around the wool trade and cotton trades and precious metal trades also. And they congregated there, and they found and developed innovative ways of financing that trade, particularly the trade that was being done internationally, to ensure that there was safety for all counterparties. And then by the middle of the 19th century, London had effectively, having sort of thrown off competition initially from Amsterdam and then from Paris, become the unrivaled banking and commercial capital of the world. A port city, a centre of the country, as I said earlier, and by then, in the Victorian era, a centre of a vast empire that was trading both within itself and without itself around the world. Following the First World War, power shifted to the United States, and particularly to New York, with the United States becoming the world's banker, a role that the great British economy, or the UK economy, had held for the preceding 100 years. But London innovated once again, and by the mid-50s had become the centre of the euro-dollar market, a market, Nick, that you would know and understand much better than I. And since then, Big Bang in the 1980s, and various both time-stamped events, but I think a continuation of the common law system that we have established over those millennia that we've been talking about. And what I would determine to be deft regulation, by and large, from the Bank of England and other regulators, has certainly post the Second World War brought hundreds of foreign banks to London. And from within that community, evolution continues. And within the world of trade and other businesses, London retains that mantle as premier financial services hub globally, even though obviously in many other respects the UK economy's position globally has dwindled and to a degree diminished over that period.
So what is it? I mean, that's a fantastic introduction to the history of trade in London, and I guess what is interesting is thinking about how that power has moved around the globe, in banking following trade. So one almost wonders whether the centre of finance should move eastwards as China grows as a trading hub, but that's probably for another time. But just explain to our listeners that are on the podcast, what is it that financial institutions really bring to facilitate trade? Why are they so important?
Yeah, I would summarize that in effectively two words. They bring capital and they bring expertise. And as I was referring to a few moments ago, arguably, although they most certainly didn't start international trade, the Lombards, those Italian bankers from 500 years ago, really were at the sort of genesis of what we still recognize today as the start of international trade in terms of inventing is probably too strong a word, but finessing the role of the letter of credit. And that's the sort of the key financial instrument used all the world over, still to this day, by banks to facilitate and effectively safeguard the exchange of goods and also indeed potentially services for fiat currency in return. So if one casts one's mind back to those Lombard bankers in medieval times, they were importing fine goods from the continent of Europe into the warehouses and merchant houses of the City of London. Those counterparties clearly back then didn't have the sort of facility to know and understand each other in commercial, contractual terms in the way that we do today with tools such as the internet, being a great tool for discovering new markets and assessing counterparties. Back then, your typical supply chain was, compared to today's environment, shorter in terms of physical distance, but much, much longer in terms of perceived distance compared to today. And through chains of interconnected banking organizations throughout the sort of trade routes in Europe, the Lombards and their equivalents in other countries were able to ensure that through documentary representation of the physical goods that were being traded through the letter of credit, that they could exercise and help control the passage of goods and the exchange of money, fiat currency, for those goods. So if you put yourself in the position of a seller, ideally you want to be sold for your goods as soon as they have left your warehouse, let's say somewhere in northern Italy. But if you're a buyer, a merchant in London buying those goods, ideally you don't want to pay for those goods until they've reached your warehouse or your merchant shop in the City of London. So there's a time difference, and that's where the bank comes in, not only in terms of providing that capital, but also through the mechanisms that still endure today for trade finance to safeguard that critical exchange of goods and services for value through mechanisms such as a letter of credit and successor mechanisms that are very, very much in use to this day.
So it really sounds like, knowing your supply chains, knowing your customer, knowing the people in them, really is one of your main controls with that kind of product that's facilitating all of this trade. And how challenging is it? We've had a situation recently with COVID. Obviously, we've it's a matter of public record that and well known that there's been a kind of race for PPE from all kinds of organisations. So new people stepping into supply chains, people having to open up with new suppliers they don't necessarily know, etc. How much of a challenge has that been for financial institutions to grapple with?
It's been challenging for institutions and for the companies involved, but actually arguably, and some might say somewhat cynically, but it is proven to be true. It takes a good crisis sometimes for companies, organisations to be reminded of the value that trade finances bring in times of low risk, or at least perceived low risk. An awful lot of trade, rising amount of trade year by year over the last number of decades has taken place on what's called open account terms, with people satisfying themselves that even over quite long distances, they've got a good enough relationship with the counterparty that they can agree payment terms that either don't need to involve the bank at all, other than the passage of the settlement at the end of the process, or if the bank is to become involved, that it's sort of through much looser financing terms than would be under strict documentary credit terms that have, as I said, have endured for generations now. What happens in a crisis is that, understandably, and then you've raised a very good reference point there in terms of PPE, tends to be massive focus on keeping global supply chains open. And unfortunately, that means that, or that presents opportunities for criminals, particularly as companies onboard new suppliers, and in the case of the current crisis, rely ever more on electronic forms of communication, which can be prone to misuse, and in certain cases, extremely sophisticated misuse. The good news, if you like, is that none of this is new to those of us involved in the world of trade finance. Regrettably, and trade finance has been prone to trade-based financial crime, TBFC, as it is referred to in the industry. The good news is that these sort of incidences of trade-based financial crime remain very, very low in terms of percentage terms, because of the controls, both at the regulatory and governmental level, but also at the institutional and commercial business level that are in place to ensure that you are safeguarding not only the individual transactions, but the overall health of the financial services system, that they're in there. But what are those sort of key elements of trade-based financial crime that can come into play? Money laundering. Trade is often used or can be used as a front for money laundering. Commercial fraud, sanctions violations. We can come back to that in a few moments. Basic bribery and corruption. Financing of weapons of mass destruction, because it's often quite hard to determine precisely what use the goods that you are financing, particularly if their component parts are going to be put to, and terrorism financing. And this is why, most certainly over the last couple of decades, but even well before that, key regulatory bodies such as the FCA, HKMA in Hong Kong, SMA in Singapore have been calling for what they call risk-based due diligence cycle of trading transaction. And this is where banks or bank financial institutions have become very expert, very sophisticated at managing those due diligence processes.
So what are the kind of things that they will go through to manage those processes? What are the things that financial institutions typically do?
Well, in order to combat TBFC within banks, there are six layers of processes. Organisation management, if you like, the banks or financial institutions in general need to consider, because the financing of trade is not uniquely these days the purview of the banks. You've got insurance companies very actively involved in the world of trade finance, also fund management companies increasingly looking at trade as a very interesting and asset class, certainly in terms of the pool of assets that they might be investing in. And what are those structures or layers within organisations? The first one is organisational. I think many of your listeners will be very familiar with the 3 lines of defence model, initially proposed by the Wolfberg Group, and the vast majority, if not totality, of financial services organisations now have operate along the 3 lines of defence protocols, and they've established processes and procedures and escalation routes and defined accountability for individuals within those organisations. So, what does that mean within a well-run bank? That means that your first line, your sales and relationship management team, take accountability for knowing who those customers are, knowing the geographies and the marketplaces in which they are operating. Your risk managers are there along with other stakeholders to support the assessment of that book of business and the individual transactions. And then obviously lastly, but by no means least, your internal audit functions, keeping an internal sort of review and supervisory function of those organisational mechanisms, of course. Then you've got what I would call the operational focus within the sort of TBFC framework. So that's undertaking financial crime risk assessments, as referred to a little earlier, particularly in relation to high-risk countries. And that's not necessarily just high credit risk countries, but that's looking at aspects such as corruption risks, political stability in countries, because trade is very, very global by its nature. Then we touched on already, but I call it the relationship lens. So ensuring that you've got appropriate onboarding controls, KYC, KYCC, enhanced due diligence where appropriate at the very initiation, not just of the transaction, but of the relationships between buyers and sellers that banks and other financial institutions are looking to finance. Critically then, within the world of trade, like many other sort of trading operations within the financial services arena, you have got very specific and very detailed transaction monitoring processes and procedures in place. Typical red flags, as we call them in the industry, would be, are the goods that are being traded commensurate with the client's typical activity? If a rubber boot trader is suddenly trading in, high-grade finished aluminium casings, particularly if they were doing so in a high-risk jurisdiction, you might start to be asking some questions of that particular client as to what they're doing. Are the value of the goods being traded commensurate with the normal trading patterns and activity? Again, it's looking out for things that are a little out of the ordinary. And 99 times out of 100, Nick, the answers are perfectly satisfactory. But it's those that don't ask the questions that ultimately are those that get into the hot water. We were referencing earlier the opportunities for using trade as money laundering. So, making sure and doing a baseline check as to whether the goods are priced in line with the market, and are goods being shipped in line with typical trade that goes across that particular corridor. I mean, there's a fantastic example, fantastic from an obvious failure of due diligence that took place. I won't reference obviously the name of the institution, but I was made aware about 18 months ago the shipment of some paper straws, a sort of base level product that any of us might buy, particularly in summertime for kids to use, when we're going to the supermarket, and a consignment of paper straws with a commercial value of probably about $12,000 was being shipped from Latin America to West Africa, a country in West Africa. Now, you'd say, well, nothing necessarily particularly unusual about that transaction. But then, as one examined the documents, all the counterparties were sort of bona fide, invalid, etc., it transpired that those paper straws were being air freighted across the Atlantic Ocean. And the value of the air freight was about 3 times the value of the paper straws. Now, in of its own, air freighting is a perfectly normal form of transport, often used in trade. But you ask yourself the very obvious question in this instance, is that an appropriate mechanism for transporting paper straws? Cut diamonds, uncut diamonds, yes, probably would need to be air freighted, but paper straws, it doesn't tend to be, a huge rush in terms of need of delivery of those in a rapid amount of time, most certainly not when the transportation costs are 3 or 4 times the value of the cost of the goods. And indeed, one starts digging a little deeper into that particular transaction, and it was a front for a money laundering scam.
That's a fascinating, absolutely fascinating case, but so great at illustrating the kind of things that you'd have to look out for. And I think you've made that very, very accessible to the listeners. I mean, I think what I'm getting from you is, all the things that you've laid out, really this year, really break down a lot of those rules, because, we're dealing with, sudden rush for, materials. I can think of, hand sanitizer as an example where, suddenly someone who has been procuring, chemicals, might suddenly switch to hand sanitizer and so on and so forth. What is the potential cost and so on? These are not, not yet known, but also fluctuating. Very, very challenging for people in this environment, wouldn't you say?
Absolutely. And, it's heightened the need, what I would call my sort of list of specific COVID crisis concerns. One, amplifies the need to really know your supply chain. That's know your supply chain if you're the trader, but also the financier involved in the financing of that. Understand it, make sure it makes sense. Make sure the right due diligence has been done on new supply chain partners. As I said, at various points in the last few months, certain key goods and materials have not been available from habitual sources. So they've been quite legitimately procured from alternative locations, but absolutely critical to know that the people that you're dealing with, the goods that you're receiving, and the financing that's supporting all of that is completely legitimate. Many firms to this day are still operating, close to 100% of their trade operations activities remotely. That has posed challenges for many institutions in what remains still today a very paper-based business line, in terms of managing those bills of lading, those bills of exchange, those commercial invoices, etc. So there have been, rapid moves, much facilitated by international bodies such as the International Chambers of Commerce, I would add, towards enhancing and bringing forward the role that electronic documentation plays within the world of trade finance. But that is, again, prone to misuse. Electronic documents, regrettably, can be doctored. It is very hard to tell from a scan of a document whether the seal and stamp of the issuing party is indeed 100% legitimate. Add into which that within your typical operations, just as like your sort of market desk infrastructure, you're working in an environment where those undertaking the process management activities are sitting alongside those with compliance and monitoring responsibilities, and all those individuals are very dispersed at the current time. So that brings challenges within the financial institutions. The good news is, another area that has really come to the fore in terms of that ongoing combating of TBFC in the last decades is infrastructure, and particularly technology that is being used in terms of transaction screening, validating transactional data, use of artificial intelligence increasingly to review transaction data and make sure that it is sense checked, at least at the baseline level. And even at settlement now, and again, many of your listeners would be familiar with this, at a retail level, confirmation of payee on transaction settlement that is being now almost ubiquitous, certainly here in the UK, but more broadly, increasingly across other countries, a great tool to make sure that the payment is going to who it should be doing. Because, again, many of us in the industry are very familiar, regrettably, with cases where sometimes long-standing employees have doctored invoices, sometimes where invoices have been electronically doctored by third parties, and a payment that was meant to be going to ND Curry Inc. Is then suddenly misappropriated, and it's being sent to ND Curry Inc. With a different sort code and a different account number, and again, all appears legitimate. But points like that absolutely beg for closer examination. And ultimately, if activity is suspicious, and this is the sort of the last layer, if you like, in a really good and well put together TBFC structure, is reporting suspicious activity, raising those SARs up to the regulator and the oversight organisations as and where appropriate. Cybersecurity is a major concern within the industry today, again, particularly with people sort of working remotely, possibly down less secure channels of communication than banks would be used to. And we're all a number of us would be very familiar with the fact that even at central bank level, systems can be hacked, such as the incident a couple of years ago when the Central Bank of Bangladesh was hacked and hundreds of millions of dollars was transferred out of accounts that the central bank had never seen again, in a very sophisticated fraud that is still being investigated, and in turn brought completely new level of control procedures into place at SWIFT, the Interbank Settlement Organisation.
So in terms of trade, I mean, obviously you talked about the importance of financial institutions, and it may not be so simple to generalize, but just give our listeners a feel for, what are we talking about here? Are we talking about, two trading partners that use, their home bank in one country and the home bank in the other? Or are we talking about, chains of what goes on in between? What does that look like?
Well, at the most basic level, you've got a buyer's bank and a seller's bank involved, typically in the financing of a trade finance transaction. And both of them might be providing what I would call trade-related finance at other stages of a sort of supply chain cycle or a working capital cycle that's related or built around that particular trade. And they then, in turn, because they're wanting potentially to manage their risk books appropriately, may well be on-selling that trade finance risk into the secondary market, either in the form of a loan participation or in the form of some sort of structured syndicated note or securitized transaction. Certainly the larger, more global banks doing that sort of thing, or sharing risk with insurers, as I said, very active in the field of financing trade for many years now. And London most certainly is one of a very small handful of global financial centres where a lot of that secondary market activity takes place, largely because one has got so many banks operating in the city. A lot of this is still done to a degree on a relationship basis, with bankers knowing which other banks may or may not be interested in certain types of risk as they look to manage their books and, as I said, distribute those assets. The fantastic thing is, and for readers that are interested, the ICC, who I do quite a little bit of work for, are about to publish their annual survey for 2020. It will contain some very informative reading about how the trade finance marketplace is operating today, the challenges that it's facing as a result of the crisis, but also some forward-looking pieces on digitalization, etc. But one of the sort of key takeaways from my proofreading of that over the last few days has been the degree to which that collaboration around risk share still continues, the number of banks that are involved in those sorts of processes, and then obviously the requirement on each and every one of those banks to do their own compliance and risk-based analysis on the transactions that they are looking at. There used to be an adage in the world of trade that banks can only review the documents as presented to them, but most certainly in this modern age, that is no longer a defence that you can be sort of blind to potential malfeasance in the underlying transaction. And if one looks at industry principles that have sort of developed over the last couple of decades, the Wolfberg principles, that being an association of 13 global banks who continually aim to develop frameworks and guidance for the management of financial crime risks, particularly with respect to KYC, anti-money laundering and counter-terrorist financing policies. Then you've got the Financial Action Task Force, or FATF as it's referred to in the industry, which is an initiative of the G7 nations to develop policies to combat money laundering and terrorism finance. And lastly, at the local level here in the UK, or more local level, you've got organisations such as the FCA, as then was, undertaking a thematic review in 2013 into trade finance. Why were they doing that? Because they recognise London's position as the global trade finance hub, and they wanted to make sure that it was activity that was appropriately reviewed, regulated and supervised.
That's fascinating. And I mean, obviously you've talked about the Wolfsburg group and very much getting the message that it's the banks that are involved. You've talked obviously about asset managers that are getting interested in perhaps some of the the more lucrative parts of the spectrum. Are there any other disruptors coming in? Is this something that can be looked at from the fintech point of view? Are there any sort of interesting angles there that people are looking at with trade?
Absolutely, there are. I mean, and this is in part been driven, by the technology, and also in part driven by the regulatory landscape, and last but by no means least, of course, by the sort of capital position of the banks themselves. For trade, broadly speaking, is an attractive asset class. It's got low default rates, and the vast majority of trade finance transactions have a tenor of under 180 days. In fact, more than 50% of them less than 90 days. So it's a rapidly turning over business that has got low default rates. It's perceived, by regulators and bankers alike as being low risk, and obviously it's absolutely critical to the world economy. And if appropriately managed and structured, it's very much a leading indicator in terms of the financial health of the companies, or at least the buying company that is involved. If a buyer is suddenly looking to dramatically extend its payment terms, one needs to start asking questions about why they are looking to do that. Again, there can be perfectly legitimate reasons for amending payment terms on transactions, but it could be, and has often been, a trigger for troubled times ahead, or an indicator of troubled times ahead. And trade bankers often get that first oversight. So it's a sophisticated, very global, very diverse marketplace. Of the roughly 250 foreign banks with a presence here in the UK, the vast majority of them are engaged in trade facilitation or trade financing of some form or other. That's one of the key reasons for being here, because it's a very baseline product that banks would be looking to offer to their corporates. I mean, I'm reminded, and you've heard me tell this story from many years ago when I was a much more junior and younger banker, going up to meet the CFO and the finance team at Nokia. And this is around the turn of the millennium. Nokia's star was very much in the ascendance, massive global business. And about 10 of us from the bank I was then working at went up to meet with them. And I was by far and away the most humble and junior banker in the delegation. But as we sat down there, the CFO at Nokia looked across the table and looked at us bankers assembled, and he said, well, there's only one guy that I really want to talk to today because he is absolutely critical to the success of my business. And you could see the M&A guy, I can't quite remember whether he was wearing wet braces or not, but he may well have been sitting there thinking, his ship had come in and he was about to land some monster transaction. And to everyone's consternation and my complete surprise, the CFO turned to me and said, Dominic, I want to talk to you because unless we can get the financing and the terms of my trade finance sorted out, there is nothing for us to talk about. It is that fundamental to my company.
Well, that's a fascinating thought. And I think that really conveys, how important this part of London's financial industry is. Well, Dominic, thank you very, very much for giving us that insight into trade finance. Absolutely fascinating. And thank you so much for being a guest on the Skadi podcast.
As ever, an absolute pleasure, and look forward to potentially coming back and talking more about this exciting and vibrant part of the world of financial services.
Well, we welcome you back. Thanks very, very much.
Thank you for listening to episode 6 of the Skadi podcast. Stick with us on this journey as we, like many of you, are trying to navigate these very uncertain times. This is the Skadi podcast.